The Evergreen State is experiencing a housing market catastrophe of historic proportions in 2026. Across Washington, real estate markets that seemed invincible during the pandemic boom are now witnessing price collapses so severe they're leaving entire communities in financial ruin. In some cities, median home prices have plummeted by as much as 58% in less than 3 years, erasing decades of equity gains and trapping tens of thousands of homeowners in properties worth less than half what they paid. Washington State, long celebrated as the Pacific Northwest's economic powerhouse and home to tech giants like Microsoft, Amazon, and Boeing, now finds itself at the epicenter of one of America's worst regional housing crashes. The same forces that drove explosive appreciation over the past decade, Seattle's tech boom spillover, remote work migration, and relentless speculation, have reversed with shocking violence. What was once a seller's paradise with bidding wars and cash offers has transformed into a buyer's wasteland, with homes sitting vacant for months and desperate sellers slashing prices by $200,000, $300,000, $300,000 from their peak asking prices. The numbers are truly staggering. Across the cities we'll examine today, average days on market have skyrocketed from under 20 days in 2021 to over 180 days in 2026. Inventory levels have exploded by 600% or more in some markets, creating an unprecedented oversupply crisis that continues driving prices downward with no floor in sight. Mortgage rates hovering between 7% and 8% have eliminated the vast majority of qualified buyers, while property tax bills that routinely exceed $15,000 annually have made homeownership financially impossible for middle-class families. Today, we're investigating the Washington State cities where housing prices aren't just declining, they're in absolute freefall, with declines of 40 to 60% that are destroying household wealth and reshaping communities permanently. From Spokane's 58% collapse to Yakima's affordability crisis, from Tri-Cities' economic devastation to Bellingham's migration reversal, we'll examine exactly what's driving these catastrophic price crashes and what they mean for the future of Washington real estate. To understand why Washington State is experiencing such devastating housing market crashes in 2026, we must first examine the broader national forces that have created this perfect storm. Then explore why Washington is experiencing these trends with particular severity. The Federal Reserve's aggressive monetary tightening has been the primary national catalyst. Mortgage rates, which hit generational lows of 2.65% in January 2021, have remained stubbornly elevated in the 7% to 8% range throughout 2025 and into 2026. This dramatic increase has effectively tripled monthly mortgage payments for many homebuyers compared to the pandemic era, removing millions of potential purchasers from the market and decimating demand. The national affordability crisis has reached unprecedented levels. The typical American household now needs to earn approximately $120,000 annually to comfortably afford a median-priced home in 2026, up from just $59,000 in 2020. This 103% increase in income requirements represents the fastest and most severe deterioration in housing affordability in modern American history, effectively locking out an entire generation from homeownership. However, Washington State is experiencing these national trends with devastating amplification due to several state-specific factors. The tech sector collapse has hit Washington with particular brutality. Amazon alone has laid off over 27,000 employees since late 2022, with cuts continuing through 2024 and 2025. Microsoft has eliminated over 15,000 positions. Meta's Seattle offices have contracted by 65%. Google, Apple, and dozens of smaller tech companies have implemented massive cuts. In total, the Washington tech sector has shed over 85,000 high-paying positions since 2023, the largest regional tech employment contraction in U.S. history. These weren't just any jobs, they were six-figure positions that supported premium housing markets. The average tech worker in Seattle earned $165,000 to $220,000 annually. When these workers lost their jobs or relocated to other states, they took their housing purchasing power with them, creating a demand crater that has devastated markets statewide. The remote work reversal has been equally catastrophic for Washington. During the pandemic, tens of thousands of workers relocated from the Bay Area and other expensive markets to Washington, assuming they could work remotely indefinitely while enjoying lower costs and outdoor recreation. However, as companies implemented aggressive return-to-office mandates throughout 2024 and 2025, many of these transplants faced an impossible choice: relocate back to expensive coastal hubs, or change careers. Many chose to leave Washington entirely, flooding the market with homes as they departed. Washington experienced explosive population growth from 2020 to 2022, with over 180,000 net new residents primarily from California, Oregon, and other West Coast states. This migration tsunami prompted developers to launch unprecedented construction across the state. Building permits in King, Pierce, and Snohomish counties alone exceeded 45,000 annually in 2022 and 2023. However, as migration reversed in 2024 and 2025, Washington found itself catastrophically overbuilt, with new construction outpacing organic demand by staggering margins. The Boeing crisis has compounded Washington's economic challenges. The aerospace giant has faced ongoing production problems, regulatory scrutiny, and financial distress. Boeing has eliminated over 22,000 positions in Washington since 2023, devastating communities in Everett, Renton, and throughout the Puget Sound region. The multiplier effect of these job losses has rippled through the entire state economy. Washington's tax structure has become a critical liability. The state has no income tax, but relies heavily on property taxes, sales taxes, and various fees to fund government services. Property tax bills in desirable areas now routinely exceed $12,000 to $25,000 annually, among the highest in the nation. When combined with 7.5% mortgage payments, these tax obligations have made homeownership financially unsustainable for most families. The capital gains tax implemented in 2022 has prompted many wealthy residents and investors to relocate to tax-friendly states like Nevada, Texas, and Florida. This exodus of high-net-worth individuals has removed significant purchasing power from Washington's luxury housing market, contributing to price collapses in high-end segments. Climate challenges have emerged as significant concerns. Wildfire smoke from regional fires has created serious air quality issues during summer months, making outdoor recreation one of Washington's primary appeals increasingly difficult. Drought conditions have raised water supply concerns in eastern Washington. The big one, earthquake risk along the Cascadia subduction zone, has gained increased attention, with insurance implications. Finally, the cost of living has surged across Washington even as housing prices crash. Gasoline prices routinely exceed $5 per gallon due to state fuel taxes and carbon pricing. Electricity costs have increased by 35% since 2022. Grocery costs are among the nation's highest. Combined with elevated housing costs even after the crash, Washington has become increasingly unaffordable for middle-class families. City number 1, Spokane. Washington Spokane's housing market has experienced the most catastrophic collapse in Washington state history. The median home price in Spokane peaked at $485,000 in April 2022, but has crashed to $205,000 as of January 2026, a devastating 58% decline that represents the worst housing market crash in the entire Pacific Northwest. Days on market have exploded from an average of 16 days in 2021 to 197 days currently, while active inventory has increased by an astonishing 640% compared to 2022 levels. The root causes of Spokane's implosion are multiple and compounding. During the pandemic, Spokane was overwhelmed by Seattle transplants seeking affordability and outdoor recreation. Home prices more than doubled between 2020 and 22 as out-of-state buyers brought their equity and remote work incomes. However, this migration wave has reversed completely and catastrophically. As remote work policies ended, transplants discovered they either needed to return to Seattle for employment or accept significant pay cuts for local positions. Many Seattle refugees discovered that Spokane's reality didn't match their expectations. Winters are harsh with heavy snowfall and temperatures frequently below 20 degrees Fahrenheit. The cultural and political environment differs significantly from Seattle's progressive culture, creating friction for many transplants. Air quality from wildfire smoke has become a serious health concern during summer months. The city lacks the amenities, restaurants, arts scene, and diversity that coastal transplants expected. Construction continued at fever pitch through 2024, adding over 8,500 new homes to a metro area of just 600,000 residents. This construction was driven entirely by speculation rather than organic demand. When the market turned, Spokane was left with thousands of excess homes and virtually no qualified buyers. The local economy, dependent on healthcare, education, and government, offers average wages approximately 40% below Seattle levels, completely inadequate to support the housing stock built during the boom. An estimated 42% of Spokane homeowners who purchased during the 2021-2022 peak now have catastrophic negative equity, owing $150,000 to $280,000 more than their home's current values. The rental market has completely imploded, with vacancy rates surging to 19.4%, among the highest in the nation, and rental prices declining by 31% year over year. Foreclosure filings have increased by 234% compared to 2023, with entire neighborhoods showing multiple foreclosed properties on every block. Property values in specific Spokane neighborhoods tell an even more devastating story. The South Hill, once commanding premium prices, has seen median values crash from $625,000 to $235,000, a 62% decline. North Spokane neighborhoods have declined 55% to 60% decline. North Spokane neighborhoods have declined 55% to 60%. New construction in areas like Kendall Yard sits largely vacant, with builders offering $150,000 in price reductions and still finding no buyers. Investors who purchased rental properties are walking away en masse, unable to cover mortgages even with tenants. City number 2, Yakima. Washington Yakima's housing market has experienced a collapse of similar severity to Spokane's devastation. Median home prices have plummeted from $425,000 in mid-2022 to $175,000 in early 2026, a catastrophic 59% drop that has left this agricultural community reeling. Inventory levels have exploded by over 580%, with over 1,450 active listings in a city of just 96,000 residents. Days on market average 203 days, with many homes sitting unsold for over a year. Yakima's collapse stems from a fundamental mismatch between pandemic-era speculation and economic reality. During the boom, investors and out-of-area buyers flooded Yakima, betting that remote work would allow high earners to live in affordable markets while maintaining coastal incomes. Prices more than doubled in just 18 months, reaching levels completely disconnected from local wages. However, Yakima's economy is based on agriculture, food processing, and healthcare industries offering median household incomes around $55,000 annually. Even at current crash prices, homes remain unaffordable for most local residents. The remote workers who drove the boom have largely departed, discovering that Yakima's extreme summer heat, routinely exceeding 100 degrees Fahrenheit, harsh winters, limited amenities, and cultural environment didn't meet their expectations. Construction during the boom added over 3,200 new homes, an enormous increase for a small city, creating catastrophic oversupply. Water rights concerns in this agricultural region have raised questions about sustainable development. Air quality from agricultural burning and summer wildfires has become increasingly problematic. Property taxes increased by 65% during the boom and have remained elevated even as values crashed, making ownership financially impossible for working families. The crash has hit specific segments particularly hard. Newer subdivisions on Yakima's western outskirts have seen prices collapse by 65% to 70%, with entire streets of vacant homes. Investors who purchased during the peak are facing losses exceeding $250,000 per property. The rental market shows vacancy rates above 22%, with landlords offering multiple months of free rent and still unable to find tenants. Foreclosures have increased by 267%, with banks now owning hundreds of properties they cannot sell. City number 3, Tri-Cities, Richland, Kennewick, Pasco, Washington. The Tri-Cities region has experienced a housing market implosion that has devastated this historically stable market. Median home prices have crashed from $465,000 at peak to $205,000, currently a staggering 56% decline. Active inventory has staggering 56% decline. Active inventory has surged to over 2,800 homes across the 3 cities, representing over 16 months of supply. Properties sit on the market for an average of 189 days, with most eventually selling at prices $180,000 to $220,000 below original asking. The Tri-Cities economic base, historically anchored by the Hanford nuclear site and related contractors, has proven insufficient to support pandemic-era price levels. The region experienced a speculative frenzy as Portland and Seattle refugees sought affordability, driving prices to unsustainable heights. Construction exploded with over 6,800 new homes delivered between 2021 and 2024 in a metro area of just 300,000 residents. However, the migration wave reversed sharply in 2024, remote workers discovered that the Tri-Cities' extreme summer heat, regularly exceeding 105 degrees Fahrenheit, harsh winters, windstorms, limited cultural amenities, and isolation, over 200 miles from Seattle, made long-term living untenable. Many returned to the Portland or Seattle areas despite higher costs. The local employment base, while stable, offers wages 35% below Seattle levels and cannot support current housing inventory. Energy sector challenges have compounded the collapse. As renewable energy expansion has accelerated, employment at Hanford and related facilities has contracted, eliminating over 3,500 high-paying positions since 2023. These job losses have rippled through the entire regional economy. Wine industry tourism, which briefly surged during the pandemic, has declined as travel patterns normalized. Specific neighborhoods have been devastated. West Richland, which saw explosive growth during the boom, has experienced price declines of 62%, with new construction sitting vacant. South Kennewick subdivisions have crashed 58% to 60%. Investors who purchased heavily in Pasco are facing catastrophic losses, with rental vacancy rates exceeding 20% and rents down 35% from peak levels. Property taxes that increased 55% during the boom remain punishingly high, even as values have collapsed. City number 4, Bellingham, Washington. Bellingham's housing market has imploded with shocking severity for a desirable college town with proximity to Seattle and Vancouver. Median home prices have crashed from $625,000 at peak to $285,000 at peak to $285,000, currently a devastating 54% decline. Active inventory has exploded to over 1,350 homes in a city of just 92,000 residents, with days on market averaging 176 days. Bellingham's collapse reflects the complete reversal of pandemic-era trends. The city became a magnet for Seattle and Vancouver transplants seeking smaller city charm, outdoor recreation access, and perceived affordability while working remotely. Prices surged over 150% between 2020 and 2022, reaching levels completely disconnected from the local economy based on Western Washington University, healthcare, and small business. The remote work reversal has hit Bellingham with particular force. As companies mandated office returns, transplants face brutal commutes to Seattle 90-plus miles each way, or job changes at significant pay cuts. Many simply left, flooding the market with listings. The Canadian buyers who historically supported Bellingham's market have disappeared due to currency exchange rates and economic uncertainty north of the border. Construction during the boom added over 2,400 new homes, massive for a small city, creating severe oversupply. Bellingham's appeal was always based on scarcity and charm, but rapid growth destroyed much of what made the city attractive. Traffic congestion has worsened significantly. The university provides stability but not growth sufficient to absorb excess housing. Rental demand from students has weakened as enrollment declines. Climate concerns have emerged as significant factors. Wildfire smoke during summer months has made outdoor recreation. Bellingham's primary appeal increasingly difficult. Air quality alerts are now common June through September. The Big One earthquake risk has gained attention, with many newer buildings constructed before updated seismic codes. Specific market segments show even worse declines. Homes in Fairhaven and Columbia neighborhoods have crashed 58% to 60% from peak. New construction in outlying areas sits vacant, with builders offering $200,000 plus in price reductions. Waterfront properties, once commanding massive premiums, have declined 50% as buyers question flood and earthquake risks. The luxury segment above $800,000 has essentially disappeared, with homes sitting unsold for over a year. City number 5, Olympia, Washington state capital, has experienced a housing crash that has shocked the longtime residents accustomed to stability. Median home prices have plummeted from $535,000 at peak to $245,000 at peak to $245,000, currently a 54% decline. Active inventory stands at over 1,450 homes, representing nearly 14 months of supply. Days on market average, 183 days. Olympia's implosion reflects multiple converging failures. The city attracted massive influx of remote workers from Seattle and Portland during the pandemic, with buyers assuming they could maintain coastal incomes while enjoying lower costs and outdoor recreation. Prices more than doubled in just 2 years, reaching levels completely unsustainable given state government salaries and local wages. The remote work reversal has been catastrophic. Many transplants have departed, unable to justify Olympia's distance from Seattle employment centers. 60 miles each way. State government employment centers, 60 miles each way. State government employment, while stable, offers wages approximately 30% below Seattle private sector levels. The local economy lacks the diversity or high-wage jobs to support pandemic-era housing stock. Construction exploded during the boom, with over 4,200 new homes delivered between 2021 and 2024, enormous, for a metro area of just 280,000 residents. Much of this construction was speculative, driven by out-of-area developers betting on continued appreciation. When demand evaporated, inventories surged to unprecedented levels. Olympia faces unique challenges that have accelerated the decline. The city's progressive politics and activism create friction with many transplants from more conservative areas. The homeless crisis has worsened significantly, with encampments proliferating and property crime increasing. Downtown Olympia has struggled with retail vacancies and declining foot traffic. Weather gray, rainy, brackenshut, and dark for 8+ months annually has proven more difficult than coastal transplants anticipated. Property taxes increased by 60% during the boom as the city expanded services, then remained elevated as values crashed. Combined with elevated mortgage rates, ownership costs are financially devastating. Insurance costs have surged by 45% since 2022. Neighborhoods in Lacey and Tumwater, which experienced the most speculative building, have seen prices crash 58% to 62%, with entire subdivisions largely vacant. City 6, Vancouver. Washington. Vancouver housing market has experienced a catastrophic implosion despite its proximity to Portland. Median home prices have crashed from $585,000 at peak to $265,000, currently a devastating 55% decline. Active inventory has surged to over 2,100 homes, with days on market averaging 172 days. Vancouver's appeal during the boom was straightforward: live in tax-free Washington while working in Portland, Oregon, avoiding Oregon's 9.9% income tax. This arbitrage opportunity drove explosive appreciation as Portland workers flooded north across the Columbia River. Construction exploded with over 7,500 new homes delivered between 2021 and 2024. However, multiple factors have converged to destroy Vancouver's market. Remote work's end has made the Portland commute, which can exceed 90 minutes each way during rush hour, increasingly untenable. Many Portland employers have implemented return-to-office mandates while simultaneously cutting positions, eliminating the high-paying jobs that supported Vancouver's premium prices. Oregon has aggressively pursued tax enforcement, requiring even Washington residents working remotely for Oregon companies to pay Oregon income taxes. This eliminated much of Vancouver's tax advantage. Portland's urban challenges, homelessness, crime, downtown decline, have worsened, making the region less attractive overall. Many Vancouver residents who worked in Portland have simply left the Pacific Northwest entirely. Washington's property taxes, insurance costs, and overall cost of living have surged, eliminating much of the state's cost advantage over Oregon. The local Vancouver economy, based primarily on retail and healthcare, offers wages 40% below Portland levels and cannot support the housing stock built during the boom. The rental market has collapsed with vacancy rates exceeding 18% as investors liquidate. Specific neighborhoods show catastrophic declines. East Vancouver subdivisions have crashed 60% from peak. Newer construction in Camas and Washougal, marketed as premium Vancouver suburbs, has declined 58% with homes sitting vacant for over a year. Downtown Vancouver condos have lost 52% of their value. Investors who purchased during the peak face losses exceeding $320,000 per property. Several critical themes emerged from Washington state's housing catastrophe that reveal deeper structural forces reshaping the region. The most striking theme is the complete reversal of pandemic-era assumptions. Remote work did not permanently change location preferences. It was a temporary phenomenon. Migration from expensive coastal cities to smaller Washington markets was not a permanent demographic shift. Housing prices could not appreciate indefinitely regardless of local economic fundamentals. The second major theme is the devastating fragility of markets dependent on migration and speculation rather than organic economic growth. Cities like Spokane, Yakima, Bellingham, and Wenatchee attracted buyers based on lifestyle narratives and remote work assumptions rather than local employment opportunities. When these assumptions proved false, markets collapsed with unprecedented severity. The third critical theme is Washington's loss of competitive advantage. The state's lack of income tax was historically a major draw. but property tax increases, capital gains taxes, high sales taxes, and elevated living costs have eliminated much of this advantage. Combined with climate concerns, wildfire smoke, earthquake risk, the state has become less attractive to both individuals and businesses. The fourth theme is the tech sector's outsized impact on Washington's economy and housing. The loss of over 85,000 tech positions has removed billions in purchasing power from the state's housing market. The assumption that tech employment would continue growing indefinitely proved catastrophically wrong. Markets throughout Washington that priced in continued tech expansion are now experiencing severe corrections. The fifth theme is infrastructure and quality of life deterioration. Rapid population growth during the pandemic overwhelmed roads, schools, healthcare, and public services in many communities. Buyers who relocated discovered that Washington's high costs didn't translate to superior services or amenities. Homelessness, crime, and urban decay in Seattle have created negative perceptions that affect the entire state. Washington's housing collapse is creating broader economic devastation. Consumer spending has contracted sharply as homeowners feel significantly poorer. Property tax revenues are declining as assessed values drop, forcing municipalities into budget crises and service cuts. The construction industry has collapsed, with small builders filing bankruptcy at record rates and construction employment down over 40% from peak. Banks face mounting losses on mortgage portfolios. The psychological impact cannot be overstated. Homeownership has been central to American wealth building for generations. Hundreds of thousands of Washington families who believed they were making sound investments now face financial ruin. The negative equity crisis is particularly severe among younger first-time buyers, who purchased at peak prices with minimal down payments. Many owe double what their homes are worth. Looking nationally, Washington's collapse serves as a warning for other markets that experienced similar pandemic dynamics. States and cities that attracted remote workers experienced speculative appreciation disconnected from local wages and saw massive construction booms face similar risks. The pattern is clear: markets built on speculation and temporary trends rather than sustainable economic fundamentals eventually face severe corrections. The Washington state housing crash of 2025-26 represents the most severe regional real estate collapse since the 2008 financial crisis, and in some cities, exceeds even that devastation. Price declines ranging from 51% to 59%. Median home values down $200,000 to $300,000 from peak levels. Inventory explosions of 500% to 640%. Hundreds of thousands of homeowners trapped in catastrophic negative equity. Entire communities facing economic depression as construction industries collapse and property tax revenues evaporate. These aren't just statistics. They represent the destruction of household wealth, shattered retirement plans, ruined credit, foreclosures, family stress, and profound economic uncertainty, affecting over 1 million Washington residents who believe they were making prudent investments in their futures. For current homeowners struggling with massive negative equity and declining values, the fundamental question is whether you can afford to stay. If you can afford your monthly payments, mortgage, property taxes, insurance, maintenance, and don't need to sell immediately, riding out the collapse is likely your best option, even if recovery takes a decade or longer. Selling at a 50% loss locks in catastrophic financial damage. However, if your monthly costs are unsustainable or you need to relocate for employment, you may face no choice but to sell at devastating losses or pursue short sales and foreclosure. For prospective buyers, Washington's crash presents opportunities not seen in generations. Prices have returned to 2016-2017 levels in many markets, and desperate sellers are negotiating aggressively on price, closing costs, and repairs. However, approach with extreme caution and realistic expectations. Purchase only what you can comfortably afford at current 7% plus interest rates, assuming no appreciation for 10+ years. Focus on markets with diversified economies and stable employment bases. Avoid cities dependent on single industries or remote work assumptions. Conduct rigorous due diligence on climate risks, earthquake exposure, and long-term viability. Plan to hold for at least 15 to 20 years. For real estate investors, Washington has become a cautionary tale. Speculation and leverage are catastrophically dangerous when fundamentals shift. Those who purchased during the boom using high leverage face total financial destruction. However, investors with substantial cash reserves and realistic expectations can acquire properties at significant discounts. Focus on cities with stable employment bases like the Seattle core or university towns. Prioritize cash flow over appreciation. Expect weak rental markets for years. Expect that full recovery may take until 2035 or beyond. Looking ahead, Washington's housing market should begin stabilizing by late 2027 or 2028 as excess inventory is gradually absorbed and prices reach levels supported by local incomes. However, recovery will be extremely slow, uneven, and painful. Markets with diversified economies and stable employment will recover faster. Cities that boomed based purely on speculation, Spokane, Yakima, Wenatchee, Tri-Cities may not see full recovery to peak prices until the 2040s, if ever. The Washington state housing crash of 2026 will be studied for decades as a case study in speculation, migration reversals, and the dangers of markets disconnected from economic fundamentals. For those living through it, the experience is financially and emotionally devastating. The collapse has destroyed the wealth of hundreds of thousands of families and reshaped Washington's economic landscape. The question now is whether policymakers will learn from this catastrophe and implement reforms to prevent future bubbles, or whether the cycle will simply repeat in another generation, destroying another cohort of families chasing the American dream of homeownership.